Thaplial, markets holding steady. Yes, you have a mixed move coming in across sectors. But let's shift focus and talk about a corporate conversation. Very good set of numbers coming in from Chalet Hotels this time around. So let's try and understand what has led to a beat on all fronts from Chalet Hotels this time around. More importantly, what is the outlook ahead? We have Mr. Shwetank Singh, the MD and CEO of Chalet Hotels. In fact, Mr. Shwetank Singh has just officially taken over the MD and CEO role at Chalet Hotels. So, Mr. Singh, congratulations on that. Let's first try and understand the kind of growth that we've seen across revenue, profits, EBITDA, and in fact, your RevPAR is also once again above that 10,000 mark after seeing around that 8,000 figure in the previous 2 quarters. So, a sharp uptick over there too. What has worked out for you well in Q3, and more importantly, what is the outlook ahead?
Thank you so much. Q3 usually is a very strong quarter, and so is Q4. So second half of the year usually is much stronger than the first half of the year, and that's to be expected. Mainly because both MICE and social moves at this time with auspicious dates being clustered around this period. So actually, it's just the fundamentals of the market that has supported us. We have, of course, done a very good job in our respective markets, beating our competition, most of them, and gaining market share. As a result, what you have seen is that our numbers are up year on year from last year. And just the Q3 numbers, if you were to see, consolidated revenue is 27% up, while EBITDA is up by 29%. But ex-residential, which is we always see our business removing the residential part because that's a one-off business for us. Between commercial real estate and hospitality, we have grown 23% on revenue and about 24% on EBITDA. So really strong quarter for us, and that kind of stays through for Q4 as well. And therefore, that will cap off another very, very good year for Chalet and for the industry in general.
Mr. Singh, let's talk about room rates. Now, room rates are at record highs, but occupancies remain, below peak levels. Now, just wanted to understand, is Chalet prioritizing pricing power over volume growth right now?
Look, this is it's a cycle in the industry. Wherever there will be cycles when you will go through a stronger ADR growth versus an occupancy growth. Sometimes the other way around. It's actually very typical to the industry, and it happens again based on different markets. What is happening at Chalet is that while we are having very strong growth in the south of the country, between Hyderabad and Bangalore, for reasons that have been well stated. The growth on ADR and occupancy has been muted in the MMR region. But also what's helped us on the ADR side is that we have added the leisure portfolio, and the leisure portfolio comes at a much higher ADR. Thereby that is bringing up the blended ADR. So it's a cycle, but what basically drives the revenue and profits in our industry is RevPAR, which is a combination of both occupancy and rate. And that's going quite strong, and that has resulted in a much better and healthier revenue and flowing through in the EBITDA because of our, of course, very good asset management practices, something that we have maintained throughout our history.
Okay, and Mr. Singh, you said that Q3 and Q4 both are traditionally strong quarters for you. Now, when I take a look at Q4 of FY25, the occupancy was above 75% last year. We've seen that take a dip. But now with in this Q4 of FY26, can we expect to see this number or something around this figure once again? And also with the upcoming summer and the vacations that will come now, where are you seeing occupancy heading?
So, January has been a bit muted across the industry, and that's mainly because there has been some social dates that have sort of moved between January and February. So January overall came muted, and especially in MMR, what happened is that election year, 2-3 days of elections were followed by a long weekend during 26th January. So that kind of impacted the MMR performance, but because of the long weekend, we gained on our leisure portfolio, and that's one of the beauties of a diversified portfolio. Overall, this quarter, as I said, will be a steady growth over last year. May not be as strong as Q3, but it is certainly going to be a very strong quarter for us. Going into summers and the following year, we expect the usual growth of of the fact that there is still a demand-supply arbitrage in the industry, and there is a growing middle-class population earning more, etc., etc. We have all spoken about the demographic dividend before. So we expect this trend of very, very strong performance to at least run for the next 3 to 4 years before even supply comes anywhere close to the demand. Recent has just come out, which clearly shows that while the supply is pegged at about 7%, demand is growing at a very healthy 9.8, 9.9%. So that arbitrage is helping the industry overall.
All right, Mr. Singh, with the Athiva brand launch and the Udaipur resort acquisition, how is Chalet repositioning its portfolio across premium lifestyles and leisure segments now?
So look, we took a very conscious call of diversifying our portfolio. We were very business location centric, and we have sort of moved away from that. And our target is to at least get 20% of our business in the leisure segment, and hence the more recent acquisitions that has happened in the Himalayas or the resort in Delhi NCR is an example of that. So we are consciously moving away and diversifying our portfolio a little bit. But having said that, we have not moved away from our original thinking. We still love big boxes in big cities. So that's a development strategy that will for us as we go along as well. In general, we expect both the spaces to continue to do really well as we progress during the 3 to 4 years. So we expect very, very strong performance going forward as well.
Sounds very optimistic. Mr. Singh, lastly, just moving away from hotels, also talk to us about your performance and the growth outlook on commercial real estate and the residential projects as well. Residential project, this time around, you've seen good growth. It's come in at 16.6 crore rupees. Just trying to understand what the growth here is on a comparable basis. And commercial real estate is also up 29%. What's the outlook here?
Okay, let me speak about our commercial real estate business first, because it is one of our business key businesses that we sort of track very closely. We are at about 2.4 million square foot of operational commercial real estate, of which we are about 83% occupied overall. We certainly expect that to inch forward. Today, our exit number, which is the rental per month, is at about 26 crores per month, and we expect it to hit about 30 odd crore per month by the end of this quarter. So again, a very strong growth on the commercial real estate side. There is another about 1 million square foot in the announced pipeline that is under construction, which is set to go live by end of FY27. So that will make our commercial real estate business even stronger. Just to remind our viewers and investors, commercial real estate comes at a very strong EBITDA margin. And actually on rental, it comes very close to 100% EBITDA margin. So it stays a very strong revenue stream for us. Residential behaves differently. First of all, just to again sort of bring us back on focus, the residential was a one-off. It's not something that we intend to continue to do. But having said that, we have managed to convert what's seen as a liability into a big plus for us, and we expect about 450 to 500 crores of cash from this business. What happens in residential is that the booking comes only after you hit certain milestones, and therefore you see a cyclicality in how we book the revenue and the EBITDA. So I won't read too much into what's happened on the EBITDA side in this particular quarter or the growth against last year, because that's not a very good way to look at the residential segment. It will be cyclical, but at the end of this project, we stand to gain about 450 to 500 crores, of which we have already booked in about 200 odd crores. So we still have 300 crores of cash flow to go.
All right, Mr. Singh, thank you so much for taking time out and speak to ET now on the earnings. Thank you so much. And with that, it's time for a short break. But then post that, we'll be joined by Mr. Vinay Rajani of HG Securities to talk more on market and also suggest his trading calls for today.